In 155 years of stock market history, there is a valuation metric that has only crossed above 40 twice. The first time was during the dot-com bubble in the year 2000. The S&P 500 went on to lose nearly half its value, and the Nasdaq over 78%. The second time is right now. But a single metric doesn't cause a crash. What causes a crash is a pattern, a sequence that plays out in stages. And if you study every major market crash of the last century, the same three stages appear before the collapse: the build-up, the narrowing, and the trigger. 1929 wrote the playbook. 2000 and 2008 followed it. And right now the pattern is repeating. Stage 1. The build-up. The 1920s were an era of extraordinary optimism. The war was over. New technologies like radio, the automobile, and the telephone were reshaping daily life. The economy was booming, and the stock market was on a tear. Between 1924 and 1929, the Dow Jones nearly quadrupled. Americans who had never owned a stock before started pouring in, and the way they did it was with borrowed money. Margin lending exploded. You could buy stocks with as little as 10% down and borrow the rest. Shoeshine boys were giving stock tips. Newspapers celebrated each new high. The belief was universal: stocks always go up, and borrowing to buy more is just being smart. Now look at today. Margin debt in the United States has hit $1.28 trillion. That is 8 consecutive months of record highs. But the number alone isn't what matters. What matters is the gap. Since 1997, the S&P 500 has grown roughly 330% in real terms. Margin debt has grown over 500%. Borrowing is rising nearly twice as fast as the market itself. And every single time this gap has widened to this degree, a crash followed. In 2000, margin debt peaked in March. The market peaked the same month. In 2007, it peaked in July. The market topped out 3 months later. The Shiller-Cape ratio, which measures the true price of the market smoothed over 10 years of earnings, is currently at 39.8. The long-term average is 17. The market is trending at more than double its historical norm. The 1929 peak was 33. Today's level is above it. And the Buffett indicator, total stock market value divided by GDP, what Warren Buffett once called the single best measure of where valuations stand, has hit 220%, the highest level ever recorded. Every time this indicator has reached 2 standard deviations above its trend line, the S&P 500 has declined at least 25% within the following years. In the 1920s, Americans borrowed to buy stocks because they believed a new era had arrived. Today, margin debt is at record highs. Valuations haven't been this stretched since the dot-com peak, and the market is priced higher relative to the economy than at any point in history. The buildup is here. The era is different. The pattern is not. Stage 2. The narrowing. In 1929, the stock market was not a broad-based rally. It was driven by a small group of investment trusts and holding companies, names like Goldman Sachs Trading Corporation, Allegheny Corporation, and the Insull Utility Group. These were the Magnificent Seven of the 1920s. These trusts were leveraged vehicles that bought each other's shares, creating the illusion of growth. Their prices soared while the broader market had already begun to weaken. Small stocks were rolling over by mid-1929, but nobody noticed because the headline index kept climbing, held up by the biggest names. Now look at this chart. The top 10 stocks in the S&P 500 today make up 41% of the entire index. That's the highest concentration in over 50 years. It's higher than the dot-com bubble. It has doubled from just 19% a decade ago. If you invest $1 million in an S&P 500 index fund, over $400,000 goes into just 10 companies. And here is the mechanism that makes this even more dangerous than 1929. Passive investing. Trillions of dollars flow automatically into index funds each month, allocated by market cap. The biggest stocks receive the most money, which pushes their price higher, which increases their weight, which attracts even more money. It is a feedback loop that didn't exist in 1929, and it artificially concentrates the market far beyond what fundamentals justify. The cracks are already showing. In 2026, the equal weight S&P 500, where every stock counts the same, is up over 5%. The cap-weighted S&P 500, dominated by the Magnificent Seven, is up less than 1%. What this means is that the biggest stocks in the market are the weakest. Beneath the surface, The same narrowing that preceded every crash is happening right now. And here is what should concern you most. In 1929, Bernard Baruch, one of the wealthiest investors of the era, went fully liquid months before October. He didn't announce it. He didn't panic publicly. He just moved to cash while everyone else kept buying. In 2025, corporate insiders at the largest companies sold over $16 billion in stock. Jeff Bezos alone cashed out $5.7 billion. The insider buy-to-sell ratio currently sits at 0.24. The historical median is 0.34. That means for every dollar insiders are buying, they're selling 4. The people who run these companies are selling. The people who buy index funds are still buying. One of these groups has more information. The market isn't broadening, it's hollowing out. This is the narrowing stage. It happened in 1929 and is happening again today. Stage 3. The trigger. On October 17, 1929, one of the most respected economists in America, Irving Fisher, made a public statement. He said that stock prices had reached, quote, a permanently high plateau. 4 days later, the crash began. The Dow lost nearly 25% in 2 days. By 1932, it had fallen 89% from its peak. Fisher himself lost his entire fortune. The actual triggers were the Federal Reserve tightening credit and growing fears over the Smoot-Hawley Tariff Act, which threatened to collapse global trade. But the triggers did not cause the crash. They ignited it. The leverage was already in place. The concentration was already extreme. The triggers simply forced the leverage to unwind. When prices fell even slightly, leveraged investors faced margin calls. They were forced to sell. That selling pushed prices lower, which triggered more margin calls, which forced more selling. The crash was not a single event. It was a chain reaction. This same mechanism played out in 2000 when dot-com earnings reality hit fantasy, and again in 2008 when Lehman Brothers collapsed and subprime leverage unraveled. Different triggers, identical mechanic. A spark hitting a system already soaked in gasoline. So what could be the trigger today? The Federal Reserve's own financial stability report from November 2025 flagged overall vulnerabilities tied to financial leverage as, quote, notable. Hedge fund borrowing has reached the highest level since comprehensive data collection began. The private credit market has ballooned from $500 billion to $1.3 trillion since 2020, loaded with the same kind of covenant-light loans that defined the years before 2008. 2026 is a midterm election year. In 12 of the last 17 midterm cycles going back to the 1950s, the S&P 500 entered a correction. The average drawdown is 17.5%. And then there is Japan. In January, Japan's bond market had its worst crash since 1999. Within hours, U.S. Treasury yields spiked. Japan holds $1.2 trillion in American debt. If they are forced to sell to defend their own currency, it would tighten American financial conditions at the worst possible time. The kindling is stacked. Any spark works. Now, before you sell everything and go to cash, here's what this pattern does not tell you. It does not tell you when. In 1998, every one of these warning signs was flashing. Valuations were stretched. Leverage was rising. Concentration was extreme. And the market rallied another 44% over the next 2 years before it finally crashed in 2000. Irving Fisher was right about the mechanics in the 1920s. He was just early. And in markets, early and wrong look exactly the same. The pattern tells you the risk is elevated, not that the crash is tomorrow. And that distinction is everything. But what it also tells you is that the margin for error has disappeared. When leverage is this high and valuations are this stretched, the market does not need a crisis to fall. It just needs a disappointment. So what should you actually do? First, reduce speculation. This is not the environment to be leveraged. Second, diversify beyond the top 10. The equal weight index and international stocks are outperforming for a reason. Third, build a cash position. Not out of panic, but because cash gives you options when everyone else is being forced to sell. And fourth, own hard assets. Gold is up over 40% in the past year. Central banks are buying at a record pace. There is a reason for that. The pattern from 1929 is not a prediction, it's a warning. And warnings are only valuable if you hear them before the crowd does.